Hi guys, it's Stock Curry, and there's some major economic news that's going to move the markets in a big way on Wednesday, Thursday, and Friday. I'm going to tell you everything you need to know to get prepared for the CPI, PPI, and earnings, so let's get into it. On Wednesday, the March CPI, or Consumer Price Index, is being released at 8:30 a.m. or about 1 hour before the market opens. Then on Thursday, the PPI, or Producer Price Index, is being released at 8:30 a.m. or about 1 hour before the market opens. The CPI and PPI are inflation gauges that help the Federal Reserve determine how much they should raise interest rates by. And keep in mind that the next Fed meeting is coming up in the beginning of next month. Headline CPI, which includes everything, is expected to rise 0.3% month over month after rising 0.4% in February. And headline CPI year over year is expected to be up 5.2% versus 6.0% in February. Now, core CPI, which excludes energy and food, is expected to rise by 0.4% month over month versus 0.5% in February. And year over year, core CPI is expected to rise 5.6% versus 5.5% in February. The reason that it is broken down this way into core CPI and headline CPI is that the Federal Reserve has very little control over food or energy. So they exclude that in order to come up with their core CPI. And that is really what they're going to end up using to determine how much to raise interest rates by at their next meeting next month. Now, with the core CPI expected to go up year over year and actually rise more than it did in February, this could lend credit to the Fed raising interest rates more than expected and holding them there for longer than expected. Now, one thing that's really interesting about expectations for CPI on Wednesday is that the headline CPI is expected to come in at 5.2% year over year versus the core CPI expected to come in at 5.6% year over year. Normally, we would see core CPI rising slower than headline CPI as the Fed is supposed to have inflation under control. But this time we're not seeing that. This time we're seeing core CPI rise faster than headline CPI. At least that's the expectations, which means the Fed is really losing control over inflation, which means they're more likely to raise interest rates higher than expected and keep them there for longer than expected. And in a minute, I'll show you just how much the Fed is expected to raise interest rates by next month. But first, I want to dig a little bit deeper into what's going on here in the economy, because Jerome Powell has said multiple times that what the Fed is really trying to control is not so much inflation, but rather inflation expectations. The Federal Reserve believes that if they can get inflation expectations down, then inflation would eventually come down on its own over time. So let's take a look at where the inflation expectations are right now. The New York Fed's survey was just released, and it shows that the outlook for credit access has hit a record low, meaning financial conditions are tight, but inflation expectations actually increased. According to a survey the New York Federal Reserve released on Monday, respondents expect prices to rise by 0.5 percentage point this year, equating to a 4.7% annual gain. Now, that is the first time the near-term outlook has increased since October, and it runs counter to the narrative from the Fed that they expect inflation to go down. In the Fed's most recent economic projections, policymakers say they anticipate inflation, including food and energy, to decline to 2.5% by the end of next year. Now, granted, expectations for inflation are down from 6.6% from the same time last year, but it's still running well above the Fed's 2% inflation goal. So, higher inflation expectations would lend credit to the Fed raising interest rates more than expected and keeping them there for longer than expected. But there's another thing we have to consider, and that is partially the fact that it takes about 6 months for increases in the rate to actually affect the economy. And the other thing is the Fed works through something called financial tightening, meaning so long as credit becomes harder to get, that in turn will cause inflation to come down because people will have less money to spend. So let's take a look at where the expectations are for credit. Those reporting that credit is much harder or somewhat harder to get than a year ago rose to 58.2%, more than half of respondents. That is the highest ever, but that data series only goes back to June of 2013 when interest rates were at zero for pretty much a decade. Likewise, the expectation that credit will be more difficult to get a year from now rose to nearly 53%. That's a good sign for the Federal Reserve, meaning that with tighter financial conditions, inflation might go down in the future after all, even though current inflation expectations are for inflation to go up. We'll have to see if those inflation expectations went out, or if the tighter financial conditions do in fact cause inflation to go down, like the Fed is predicting. But one thing that is really interesting about this Fed survey is that it's looking more and more likely that we will get a recession this year. The outlook for missing a minimum debt payment in the next year rose by 0.3 percentage points to 10.9% of respondents. So 11% of people think that they're not going to be able to pay all of their bills by the end of this year. The survey also showed less optimism about stocks, with just 35% expecting higher prices a year from now. With 2/3 of people expecting the stock market to be lower a year from now than it is right now, that should be a pretty big red flag for investors. All of this combined has futures traders expecting a 72% chance of the Fed raising interest rates at their next meeting and only a 28% chance of the Fed pausing. Those expectations did rise after the Fed survey came out. And in another sign that we may be entering a recession, Apple's Mac shipments fell by more than 40% last quarter, which was even worse than all of their major rivals. Apple's worldwide computer shipments fell 40.5% year over year in the first quarter of 2023, amid a broader contraction in consumer demand. All 5 of the largest computer makers saw double-digit drops in the first quarter shipments, reflecting both weaker consumer demand and persistent inventory woes. Researchers say PC makers can expect elevated inventory to persist into the middle of the year and potentially into the third quarter. And the reason for that is a significant slowdown in consumer demand as consumers spend more and more money on necessities such as groceries and less money on things that they don't really need, such as computers. These inventory gluts, where warehouses are overflowing with inventory, is affecting not only computer companies, but retailers across the spectrum. And we've talked a lot in this channel about a lot of the different retailers who are struggling with a ton of excess inventory. We talked about how that excess inventory, which is now being sold off at losses, as well as the increased cost of storing that inventory, is expected to hit the bottom line of major retailers, including Walmart and Target, this earnings season. And speaking of earnings season officially kicks off on Friday with a lot of banks reporting. While we do have some companies reporting earlier in the week, such as Tilray on Monday, CarMax, Albertsons, Skillsoft on Tuesday, and Rent the Runway and Sportsman on Wednesday, as well as Delta, Progressive, and a few others on Thursday, earnings season officially kicks off on Friday with JP Morgan Chase, Citibank, Wells Fargo, PNC, BlackRock, and others all reporting earnings Friday before the opening bell. And this earnings season is going to be very interesting, especially given the fact that the banks sold off significantly last month. It will be interesting to see just how those banks ended up faring, if some of their balance sheets got better, some got weaker. Essentially, all of the earnings that we have from prior quarters, you can just throw them out the window, because the bank runs that happened last month, they changed everything. And everybody's really in the dark right now when it comes to banks. But we're about to come into the light once banks report earnings on Friday. And that is expected to be the third major market mover this week, with CPI moving the markets on Wednesday, PPI moving the markets on Thursday, and earnings moving the markets on Friday. Now, if you want to keep up to date on everything that's going on in the markets, I actually have a free newsletter that I put out every single week. That free newsletter goes out on Monday mornings, sometimes Sunday night, depending upon where you live in the world. If you want access to that free newsletter so that you will know what's going on and get prepared for the week ahead, you can sign up for that at stockcurry.vip/newsletter. That's stockcurry.vip/newsletter. If you enjoyed this video and got a lot out of it, then be a good friend and share this video with your friends and family and on your social media pages, so that all of your friends on Facebook, Twitter, and elsewhere will know what's going on in the market ahead, and they will get prepared for CPI as well. And if you want to dress for success, check out some of the merch down below. And I hope you guys have a lot of success trading. Don't forget to hit the like button and subscribe. And if you missed the video that I put up on Friday or Saturday, was it, where I talked about what I bought in the Millionaire Club portfolio, make sure you watch the last video that I uploaded here.